All righty. Well, good morning, good afternoon, and good evening to everyone who's joining us today. We really appreciate that you've taken the time from your day to be with us. We have attendees registered from 34 countries for this event, so it's truly a global affair, and I guess a topic that a lot of people are super duper interested in. So today we are honored and thrilled to hear from Bjarte Bogsnes. Bjarte is a pioneer in the Beyond Budgeting movement and chairman of the Beyond Budgeting Roundtable. He speaks frequently at business events worldwide, is a Beyond Budgeting coach, and has won a Harvard Business Review McKinsey Management Innovation Award. He's also author of This is Beyond Budgeting, a guide to a more adaptive and human organizations, as you can see on the screen, which was published in 2023, and of Implementing Beyond Budgeting, Unlocking the Performance Potential. Moreover, Bjarte is currently founder of Bogsnes Advisory, which offers beyond budgeting implementation support and workshops. Prior, he led the implementation of Beyond Budgeting at Equinor, which was formerly Statoil, which is Scandinavia's largest company, and a similar initiative in Borealis, one of the companies that inspired the Beyond Budgeting model. So to say that he's an authority on this topic would be quite an understatement, and I probably left out half of his resume in the process. So thanks to Bjarte for joining us. We really do appreciate it. So today's program is thus, we are going to have a two-slide introduction to Finario for those of you who have joined us who are not familiar with our platform. It'll be super quick, I promise. And then we're going to set the stage for the Beyond Budgeting Imperative with some quotes from his book or books. And then we'll have our discussion, which I think you'll find fascinating and quite useful in your day-to-day functions. And then lastly, we're going to have a quick look at our platform and ways that it can help put theory into practice. And that will be, time permitting. And lastly, we'll leave some time to answer your questions. In that regard, there is a Q&A panel to the right of your screen that you can use to input your questions. Please feel free to do that during the session. If we can, we'll inject it into the conversation. If not, we'll wait to the very end. And then lastly, note that you can view the event in full screen by toggling the bracket icon on the right-hand corner of your screen. We find that's a great way to avoid the distraction of all the other stuff that's coming across your desktop during the day and focus squarely on what we're talking about. But of course, that's entirely up to you. So without further ado, here's a very quick intro to Finario. Our platform is the industry-leading enterprise Capex solution that gives finance and operations teams the data, the intelligence, and the insight necessary to be more effective in their roles and produce tangible results. We're the only solution that covers the full Capex lifecycle, from sandbox ideation through the entirety of the planning and budgeting process, processes, I should say, dynamically automated request and approval workflow, project forecasting, and post-completion review. So you can see from start to finish, we've got you covered. We integrate with your ERP, such as SAP, Oracle, or JD Edwards, your EPM or Enterprise Performance Management platform like Hyperion or OneStream, your treasury software if you have it, such as Kyriba, or even your construction management solution such as Procore. And because we can port actuals into your systems, your forecasts are always accurate, and that's something we'll actually be talking about in just a minute. Lastly, in our introduction, many of the best companies around the globe, such as the ones you can see here, are Finario users. We're in 70 plus countries across more than 30 industries. And at any given moment, there are billions of dollars, euros, or yen being managed in our system. Lastly, it's important to note that we are SOC 2 Type 2 certified, which means we provide the gold standard in data security, obviously something very important, particularly to those in finance. So that's the super quick summary. I promised it would be fast. Obviously, if you'd like to know more about us, we'd love to get in touch in the days that follow. So now on to Beyond Budgeting. Let's set the stage. So here are some quotes that were captured from Bjarte's most recent book. This is Beyond Budgeting. And here are some quotes. So the first one is, bureaucracy is the management model that underpins virtually every organization. So I'm guessing the vast majority of you watching right now with us today would nod your head in agreement to that concept and that comment. Here's another one. Budgeting is about power as much as money. Managers index their authority by the size of the budgets they command. The harsh reality is that this helps to explain why processes that have been proven ineffective are allowed to continue and tolerated year after year after year, which we hear virtually every day of the week that we're out talking to customers and prospects. And here are some of the bad behaviors that were referenced in that prior quote: lowballing, sandbagging, resource hoarding, and what I call use it or lose it spending, or what is referred to here as frenzied December spending. And then lastly, here's a couple of data points from his book. This is Beyond Budgeting. Only 17% of the managers polled by the Wall Street Journal believe that their budget process is effective, which of course means that 83% think it's ineffective. 60% of those companies reported that their annual budget targets became obsolete by the second quarter. I'd venture to guess that if you ask them, most would say it's obsolete by the second week or month. We hear all the time it's obsolete before the ink even dries on the budget. And then only 32% of companies in a McKinsey study think that their capital allocation process is very or extremely effective. Again, which suggests that there's a ton of room for improvement. So at the end of the day, if you peel it all back and boil it all down, this is what we're here today to discuss. An antidote to that problem, and it's one that has really caught the fancy and attention of the C-suite around the world. And we're hoping to shed some light on that for you today. One thing I do want to call out, and Bjarte was kind enough to remind me, is that this is not just about budgets. It's a challenge to traditional management in which the budgeting process is but a part. So think of this, also more holistically. So in a nutshell, and we'll come back to this in a second, Beyond Budgeting leans on these 12 fundamental principles and processes, which you'll hear about much more in a minute. It's a management philosophy that looks to replace traditional processes and management approaches with those that are more transparent, more flexible, more agile, more realistic, bias-free, and based on the simple idea that good business decision-making should be good for everyone in the company. Some of the key points that we'll be talking about today are relative versus fixed target setting, forecasts that are lean and unbiased versus rigid, and resource allocation that takes more of a zero-sum approach versus fixed and actualized. And lastly, a question that Bjarte seems to get often is, okay, so who's doing this? And here are some of the companies that have adopted this framework as shown in his book. So you can see quite a few, and I suspect it's growing quite rapidly. So without further ado, I'm going to jump back to this slide. Bjarte, welcome. I hope I did justice to the setup. So, having briefly shared these 12 principles, now can you dig in a little deeper and give us some color and context about how we should be thinking about these principles?
Yes, let me do that. So again, thank you for the invitation. I've been looking forward to this. And I think that was a good introduction of what this is all about. And this model and these principles challenge traditional management. And the two main assumptions behind traditional management is, number one, you can't trust people. Number two, the future is predictable and plannable. And those two assumptions we challenge because we don't believe that's true. We believe that most employees actually can be trusted, and it shouldn't be difficult to agree that the future is not very easy to predict and plan. And that is why we are addressing not just management processes here, but also leadership principles, because there is a people and leadership dimension here. But if we start on the left-hand side, if you look at what we say about purpose and values and transparency, autonomy, those are not unique recommendations from Beyond Budgeting. You would find a number of other communities, models around leadership saying very much the same. But very often, these models, these communities, have not reflected very much on what kind of management processes are needed to activate these good leadership intentions. And that is what Beyond Budgeting is offering. Very tangible, concrete, and tested recommendations on a number of management processes, including but not limited to budgeting. So on the right-hand side, the management processes, the first three are actually describing the three different purposes behind a budget, namely target setting, forecasting, and resource allocation. And I believe we will come back to why this cannot be combined in one process and one set of numbers. So we recommend to separate it and treat it as indicated here in these principles. And we also have a view on performance evaluation and rewards. And last but not least, also the rhythm, the cadence of these processes, where we recommend them, where it makes sense, where it's possible, make these processes more business-driven, more event-driven, and less calendar-driven. These principles are principles, so this is not the recipe. What this should mean in your organization, that depends on your business, your culture, your history. So nobody can do this for you. I mean, you cannot kind of just pick from a recipe list of what you should do. I mean, you need to think for yourself here. What should this mean for you? What is very important here is coherence between what we preach on the left-hand side and what we practice on the right-hand side. And a classical example of the opposite that we find in so many organizations is that if you take on the left-hand side principle 4 about autonomy, it doesn't help that executives talk loud and warmly about how fantastic employees we have on board, and we would be nothing without you, and we trust you so much. But not that much. Of course, we need detailed travel budgets. I mean, this is hypocrisy. People notice, and the words on the left-hand side become hollow because what we do on the right-hand side has the very opposite message. And what we do always speak 10 times louder than what we say. So this coherence here is key.
Got it. So I'm going to turn this off for now, and we'll stick to our conversation. So that's a great summary. Thank you. So you alluded to there being 3 distinct processes that are kind of critical in the right-hand side of that chart: aspirational targets, forecasts that are dynamic, and lean and better resource allocation to optimize scarce resources. Can you give us a high-level view of what each of these entails? Like aspirational targets is something I think that's a pretty new concept to a lot of people who are, kind of habitualized to their annual corporate budget, which is kind of where we kicked off this whole conversation. Can you give us a little flavor of what that means?
I will, but let me first say a few words about why this cannot be done in one process and one set of numbers. Because in a traditional budget process, let's assume that upstairs finance, they want to understand next year's P&L and cash flow. And they start on the revenue side and ask responsible people, what are your best numbers for next year? But everybody knows, every manager knows that what I'm sending upstairs will most likely come back to me as a target for next year, maybe with a bonus attached to it. And we all know that insights that tend to do something with the level of numbers submitted. And I think we all know which way those numbers would move. Moving to the cost side, OPEX, CAPEX, the same people, other people are asked, what are your best numbers for next year? But everybody knows that this is my only shot at getting access to resources for next year. And many might also remember that 20% cut from last year. And that memory and that insight might also do something to the level of numbers submitted. And this is a problem, not just because it destroys the quality of numbers, but also because it stimulates this at least borderline unethical behavior that we talked about, the lowballing, the gaming, the sandbagging. Even if I don't blame people behaving like this, because these people are just responding to the model we have designed for them to operate within. So if we want to change behaviors, it's not about fixing people, it's about changing models, systems, which again changes behavior. And that is what Beyond Budgeting is doing, because some people find these principles a bit big and a bit scary, and a very practical and tested way to get started is to separate these three budget purposes into three different processes, right? Because they are different things. A target that's an ambition, it's what we want to happen, right? While a forecast is an expectation. It's what we want to happen. It's what we think will happen, whether we like what we see or not. Brutally honest, the expected outcome, 50-50. And resource allocation is about optimizing what is often scarce resources, namely money and sometimes people. And when we have separated, first of all, we allow targets to be more ambitious than forecasts, which they typically should be. But also that separation enables us to improve each of the three in ways impossible when it was all bundled in one process and one set of numbers. So for instance, on targets, then we can start to think in new and different ways. And we think that we can here find some inspiration from sports, from, for instance, soccer or football. And, I have yet to meet or hear about a football soccer team saying that the ambition for next season, well, that's 39 goals and 42 points. Those are budget goals, and they don't think like that. For them, it's all about doing well against peers and hopefully better than everybody else. So that relative thinking when it comes to setting targets can be, and measuring performance is something we recommend, again, where it makes sense, where it's possible. Can be applied in comparing your company with others. It can be applied internally in comparing comparable units with each other in a kind of friendly competition, which is just as much about learning from each other as competing. Then we can move to the forecasting, because we need to get the bias and the gaming out of forecasting. And the way to do that is through this separation, because in this model, a forecast is just a forecast. It is not the bid into a target negotiation, because we have a different process for that. It's not an application for funds on OPEX and CAPEX, because we have a different process for that. It's just the forecast. And also we are saying that we don't need a million details in this forecast. We are looking at the future, which is very different from looking at the past. We look at the past through accounting, and in accounting, the decimals and the details are not just often required, but also more relevant, because looking at the past, there is no uncertainty. The moment we turn around and look to the future, whether it's capital planning or others, there is uncertainty. And then we need to accept the fact that, or understand we can't operate with the same detail level, right? We need to accept the fact that there is uncertainty and ambiguity, and even thrive on it, make it into a competitive advantage that we are good at dealing with that. And last but not least, resource allocation, which is where we get most of the questions around beyond budgeting. How do you manage costs without a budget? And here we have many recommendations. We tend to separate them into how do you treat Capex and projects, investments, and how do you treat operating costs. On Capex, we recommend a very simple concept. I mean, if you take Equinor, my former employer, which I left a few years ago to be able to work full-time with Beyond Budgeting, Equinor has no traditional annual investment budget where you sit in the fall the year before and decide everything, exactly how much to invest, exactly split on these projects, and then these bags of money are handed out to each project as next year's budget money. Instead, there is a process, a much more continuous process based on a principle which simply says the bank is always open. And where is that coming from? Well, I mean, imagine in our private life, if our car breaks down in April and we need a bank loan, imagine that you go to your bank and ask for a loan and they politely tell you that, sorry, we are only open for lending in October. And of course, no bank would tell us anything that's stupid, but that's exactly what companies operate. And by the way, imagine if the bank then added on that, I note that you have some money on your current account. If there's anything left by December, we will take it. No bank would say something that's stupid, but again, that's what the budget process is about. So what we recommend is that the business should always be able to forward a project for approval at any time. Whether you get a yes or no depends on two things. First of all, how good is your project? Evaluate it against the criteria that you use today, financial, non-financial, sustainability, whatever. Mm-hmm. And second question, can we afford it? Do we have the financial capacity as things looks today? And where is that information coming from? It's coming from unbiased, trustworthy cash forecasts, right?
Yep.
So it's not that easy when it comes to investment projects. And I can say a bit more later about some other recommendations here. But on operating cost, admin cost, then we have a menu of different recommendations. What we want to leave behind is that detailed annual budget where the budget is often as detailed as the accounts itself. There's budgets for salary, overtime, consultants, and travel, and steel and power, and all the kind of cost accounts, sometimes divided into 12 monthly budgets. Too detailed, decided too early, and often also decided too high up in organizations. So one alternative here is what we call either a frame or a burn rate guiding. There is still a number, but not kind of a detailed decimal number. In the range of 1 million, 10, 50, whatever, within that, you have the full autonomy to spend in the best possible way. Big difference between the two, but we can move further because we can move from what we call the absolute world, operating with absolute numbers, like 10, 50 million, whatever, into thinking in relative terms. And relative here is about thinking unit cost. So you can spend more if you produce more. Your constraint is a dollar per unit constraint. So you can spend more if you produce more, spend more if you sell more, whatever. We can, instead of have a specific dollar number on that unit constraint, we can make it even more self-regulating, say that your unit cost should be competitive to peers, internally, externally. So they should be lower than average, for instance, which is even more self-regulating. If you have internal profit centers with a bottom line target, that's also a way of managing cost. That unit cannot run away and spend like crazy, but it might be okay to spend what we call good cost, because good costs create value. It's the bad cost we want to get rid of. And the last alternative here, which is the most radical, is what I sometimes call nothing at all. No budget, no target. The only numbers we have in this alternative are actual cost numbers. And we do trend monitoring on these actual cost numbers. And if these trends looks okay, we do nothing. If it looks a bit strange, we investigate. It might be a doses of good cost, no problem. But, and this is important, we might also come across managers who consciously or unconsciously abuse the trust that lies in this model. And the only thing you know if you show trust in an organization is that someone will abuse it. That's not the question. It will happen. The issue is, how do you respond? And the wrong but simple response for a CEO or a CFO is to say that, hey, this trust thing doesn't work. Look what happened here. Look what happened here. Everybody back to the old budgeting process. Very simple, very easy, but the wrong thing to do. The right thing to do is to deal firmly with these people and let it have the necessary consequences. This is not about being soft. It's about not putting everybody in jail because someone has done something wrong. Yeah. In addition to these alternatives, we have two general guardrails that we also recommend. And this is something that most companies have in place already. That could be spending decision authorities. So any decision above X million, you need to go one level up. And it could be spending guidelines. One example, again, from Equinor, there's no travel budgets. But if you fly in Europe, then you fly economy, coach. If you fly intercontinental, you can fly business. It's got nothing to do with travel budgets, but it helps people to make decisions.
Got it.
So that was an overview of alternatives on the cost side.
Awesome. So quick question that came to mind while you were speaking is, in the age of advanced analytics and AI and empowered and kind of in some cases, overwhelming amount of data, are those things resolving some of these issues or just compounding some of them in the way you talk about it in terms of beyond budgeting?
Yeah. Well, I get that question a lot, especially about AI and what will it mean. And to be quite honest, I don't have a clue. I simply don't have a clue. The only thing I do know is that if AI somehow should help companies make budgets faster and more efficient, that will not solve any of the problems that we have pointed to when it comes to budgeting. So, but again, beyond that, we will find out one day.
It's an honest answer, yeah, and I think a lot of companies would probably respond the exact same way, right? Because it's hard to know. So one of the points you make in your book is the idea of organizing dynamically around, I think you call it business rhythms and events, not just the calendar, which you alluded to a moment ago, and that impacts how and when you have to when you should, I guess, update your targets. Can you give us some more perspective on this and how you practically apply that idea?
Yeah. Well, first of all, I mean, the calendar cycle of typically January to December, that is from a pure business point of view, very often a completely artificial construct. I mean, not from an accounting point of view, not from a tax point of view, but the stuff we are talking about here, then, I mean, business has its own rhythm and stuff happens when it happens. So when it's possible, when it makes sense, we need to reflect this in the cadence of our management processes. And when we have separated into the three, target setting, forecasting, resource allocation, we can organize each of these on different rhythms, which they typically would be. When it comes to targets, you don't change targets that often. But here we recommend, I mean, change targets when there's a need for it, and let them have a time horizon that reflects the urgency. I mean, if it's urgent, have a shorter time horizon. If it's more complex, have a longer one. Moving to forecasting, of course, you would change your forecast and update forecast more frequently. And we might come back to that, but there are different ways here on what you recommend on the cadence, rolling forecasting, dynamic forecasting. And last but not least, resource allocation should, as I just described, take place more or less continuously, right? Making decisions at the right time, which is as late as possible, at the right level, not everything at the top, and for the right reason, because having money left on your budget is not among those reasons.
Yeah, So you just mentioned, and it was going to be my next question about rolling forecasts or dynamic forecasting, and that's something a lot of our customers ask them to assist them with quite frequently. Can you talk about some of the ways you can actually implement that, or and importantly, for those companies that are hesitant to go all in on something like Beyond Budgeting, I suspect a lot of them are taking more of a success in increments kind of approach, or to tackle one area of the business before the next. Can you make a case for starting with Capex and project portfolios as a kind of an ideal way to start putting these Beyond Budgeting principles into action, and some of the change management, factors that go into that decision-making process?
Yeah, yeah, yeah. No, of course, there are different ways of getting started here. This is one way, and I'll come back to that. Others start out with pilots. It could be subsidiaries or business units. Others go big bang, and we've seen it all. When it comes to starting with capital projects, yes, it is possible, but then you have to make it into not just an issue of changing your forecasting around these projects. You also need to change the resource allocation, how you do it, letting the bank be open all the time. And you might also want to think about how you target set these projects. Because it's quite interesting with projects when we evaluate projects in financial terms, then I think we are quite good looking at we think value. We try to calculate net present value on these projects. I think the issue is that when we have made the decision and we get started, then the focus narrows to time and cost, and we forget the value dimension. But in my view, I mean, it is not necessarily a problem to overrun both on time and cost if it has no other negative consequences, if it increases value. So I think that too often we are too blindly focused on time and cost, and even if it has negative value consequences. But so again, yes, you can start with capital projects, but you need to think about all the three dimensions. And when it comes to one link to this question, one thing that Equinor did on projects, and that company invests between 10 and 15 billion US dollars a year, so it's quite capital intensive. In the very early days of Beyond Budgeting, and this was 20 years ago when the company started out, almost 20 years, 2005, then in those early days, there were still project budgets. But again, there was this dynamic approval of budgets, but when it was approved, you got the project budget. You got it for the lifetime of the project, not just next year. But then a few years later, we actually took this separation of budget purposes with us onto projects as well. Because let's assume that in the old project budget time, let's assume that there was a number of 100, which was the project budget. That number still exists. But today, that would be the forecast that was applied to this project when you made the decision. So that's the number that went into the net present value calculation, the forecast. But then there are two other numbers. Of course, if that forecast is 100, nobody would mind seeing it coming in cheaper. So there might be a more ambitious target of, say, 95. And the third number is about resource allocation mandates, because if 100 is a 50-50 number, then the likelihood that the project will end above is just as high as ending below. So to avoid that every second project on average need to go back and ask for more money, you can upfront set the more robust resource allocation number of, say, 105. So no project needs to go back and ask for more money before they think they will exceed 105. 95 is still the target, and of course the number of 100 will start to move on day one of that project because it's a forecast. And that has turned out to be quite useful in managing projects in a more kind of flexible and dynamic way.
Yeah, so you talk about time and cost, and really the ultimate harbinger being value. Where does ROI modeling fit into this scheme in terms of at least attempting to determine what the future value might be, which, in whatever metric you decide to use. Because I mean,
at Equinor, we didn't make kind of big changes in how we evaluated projects, and it didn't become neither easier than more difficult. So beyond that separation of the three, it was more about changing the timing of when we made decisions, right? So letting the bank be open all the time instead of just a month in the fall. That was the major change here.
And is what you're describing essentially zero-based budgeting, or is there some nuance to it that's different?
No, absolutely not. I mean, I don't want to offend anyone here, but I'm not a big fan
That's why
of
I'm asking.
zero-based budgeting. Yes, because I've seen it kind of regain some popularity, but zero-based budgeting solves very, very few of the problems that this process causes. Very few. So you still struggle with the same gaming and the resource hoarding and all that stuff. So it's just as much work and so on. So it is a dead end, if you ask me. Not recommended.
So I mean, if zero-based budgeting is essentially bottoms-up budgeting.
Well, no, it's more about starting. I mean,
is it still valid or not?
I think what they say is that, I mean, you're supposed to start from scratch every year and kind of forget anything about So it's starting from scratch, but I don't think there's a difference in where you start from. Are you building this from the bottom or from a higher level? I think it's more about kind of starting everything on zero. I might be too hard on zero-based budgeting here, but I think it's not. It doesn't address at all the two questions, those two main assumptions behind traditional management and budgeting, that people can't be trusted and that the future is predictable and plannable.
Got it. My computer is froze for a moment. Give me 2 seconds.
Yep.
I hope you can hear me. Yeah,
I can hear you.
Second. So, how dependent is having what is commonly referred to in our business a single source of truth for data? I mean, how critical is it having reliable access to up to date data that's coming from multiple parts of the business into a single repository, from what you've seen in terms of your experience with this model or this approach?
Well, I think, I mean, at least two areas where systems plays an important role here in Beyond Budgeting is, I mean, you mentioned one, having one version of the truth is of course very important, but there's another one that is kind of equally important, and that is transparency. That having the more kind of common systems you have, the more transparent you can be. And I'm mentioning transparency because that is actually one of the control mechanisms that we recommend, especially on cost. And I'd like to share with you a nice little example from a pharmaceutical company called Roche, European company, quite big. They are today on a Beyond Budgeting journey, and some years ago, they did a very interesting experiment on travel cost. In a pilot, they kicked out the travel budget, almost all travel rules and regulations, and replaced it with full transparency. So with a few exceptions, everybody could see everything. If you travel, to where did you fly, sleep, eat, cheap or expensive? Open for your colleagues to see, and vice versa. And guess what happened with travel cost in that pilot? Cost came down through a simple self-regulating control mechanism. This was about tearing all pages in that rules book instead of the opposite. And of course, without a good system to back this up, it's very hard to create that transparency. So one version of the truth and transparency are two important issues here from a systems perspective.
That makes sense. So the last question I have, and then I think we have one or two from our audience, which I'll try to get to before we flip to our demo. So one of the loudest narratives in business nowadays is agile decision making and being, having the ability to pivot quickly in the face of black swan events and business disruption and
Mm.
changes in consumer demand and whatnot. Um, you had mentioned earlier when we spoke that you can't really be agile without beyond budgeting. Can you expand on that a bit? I thought that was really quite interesting.
Yeah. No, I mean, what I'm going to say is no criticism of agile, which is, of course, agile is about um, much different and better ways of developing software and how teams work. And it's been a great success. It's really, I mean, that has revolutionized software development. So a natural next step has then been to scale agile. And so many companies are on so-called agile transformation journeys. But what they discover is that agile was not developed and designed as a way to run an enterprise. So when you try to scale it, a lot of holes become visible in agile. If you look at the management process side of Beyond Budgeting, agile doesn't give you much advice about target setting, forecasting, resource allocation, performance evaluation, rewards, right? So
Yeah.
these are the holes that Beyond Budgeting is filling. And that is why the combination of Beyond Budgeting and agile is a very good one. And a lot of the companies that have requested our help are companies on agile transformation journeys that discover just what we talked about, and they see that something is missing, and that is what Beyond Budgeting can offer.
Got it. Makes sense.
Could I say one more thing before we close here? I'd like to go back to forecasting and the difference between what we call rolling forecasting and dynamic forecasting. Many companies going beyond budgeting, they implement rolling forecasting, which is typically about getting out of what I call the accordion rhythm of traditional forecasting. Quite a lot of paradoxes. If you look at the traditional planning and forecasting rhythm companies, it's quite it's so different, because all the long-term planning, the 5-year business planning, that is rolling. You do it every year, and every time you do it, you look, for instance, 5 years ahead. The moment you move to short-term forecasting, then the concept is very much the opposite. Then it is forecasting against the wall, or accordion forecasting, as I call it. Right? So we sit there and we make our budgets. We want to understand 12 months ahead. Moving into next year, first quarter, then suddenly 9 months is enough. We can still see till year end. And then 6 months is enough, and 3 months is enough, before we suddenly get interested in 12 months again, because it's budget time. So you have this accordion forecasting, which is completely, doesn't make sense.
Yep.
So our recommendation is to either think rolling, also on the short-term forecasting. So a rolling forecast would be typically updated every quarter, and many would then look 5 quarters ahead every time. Some do 6, some do 4, but 5 is quite common, because then at least once a year you can see the full calendar year. In Equinor, we actually went for something different, because there is quite a lot of variety in the business rhythms, everything from oil trading to exploration, production. And you can't, and a lot of activities in between with different rhythms. So you can't force all these different businesses and activities onto a common frequency of every quarter and always 5 quarters ahead. So we introduced dynamic forecasting, which means that there is no predefined frequency. Business units update their forecasts, Capex, OPEX, when there is a need for it. When they see stuff happening that they think justify a forecast update. They are not doing it for corporate. They do it for themselves in order to manage their own business. That information goes into a common database. So corporate can at any time tap into the latest forecast version on cash, for instance, when there is a need for it, ahead of communication with the market, ahead of a major acquisition, and so on. So dynamic rolling, there's no right or wrong, but it's 2 different versions of what we recommend, depending on your business.
It's actually a great segue into what we're going to show folks now for just a quick few minutes, because the ability to do either is really a great advantage, particularly if you're transitioning from one approach to the other. And just having command of your cash flow forecasting. So Bjarte, thank you so much.